The stock market has created enormous wealth across generations. It has turned small savings into great fortunes. It has helped ordinary people become financially free. Yet the same market has also destroyed wealth for those who enter without preparation. Many people arrive with excitement, hope, and dreams, but they leave with confusion, frustration, and loss. The difference between success and failure in the market is rarely intelligence. It is usually discipline, patience, and understanding. As Benjamin Graham wisely said, the investor's chief problem and even his worst enemy is likely to be himself. The market tests human emotions every day. It tests fear during falling prices. It tests greed during rising prices. It tests patience when nothing seems to happen. Those who learn to control these emotions gain a powerful advantage. Great investors across history have understood one important truth. Survival comes before success, as Warren Buffett often reminds investors. The first rule of investing is do not lose money. This idea may sound simple, but it carries deep wisdom. If an investor survives the storms of the market, time begins to work in their favor. Compounding slowly transforms patience into wealth. Think of investing like sailing across a vast ocean. The ocean can be calm and rewarding, but it can also produce sudden storms and dangerous waves. A wise sailor does not rely only on hope. A wise sailor carries strong protection and clear rules for survival. This book presents such protection. It offers 18 simple rules that act like a shield for investors. These rules do not promise quick riches. Instead, they help investors avoid the most common and costly mistakes. They help investors stay calm while others panic. They help investors remain disciplined when emotions rise. Each rule builds a layer of protection around your capital and your thinking. The journey begins with the most important principle of all. Before thinking about profits, an investor must learn how to protect their money. This leads us to the first rule of the investor's shield. Rule 1. Protect your capital first. The first responsibility of an investor is not to make money. The first responsibility is to protect money. This idea may sound surprising to many beginners. Most people enter the stock market thinking only about profits. They imagine quick gains, rising charts, and stories of sudden wealth. Very few begin their journey by thinking about protection. Yet every experienced investor understands a powerful truth. Survival in the market comes before success. If your capital disappears, the opportunity to grow wealth disappears with it. But if your capital is preserved, time gives you endless opportunities to grow. The stock market is not a battlefield where the fastest person wins. It is more like a long journey through changing weather. Sometimes the road is smooth and full of opportunity. Sometimes storms appear without warning. Those who survive the storms eventually reach their destination. This is why the greatest investors in history always speak about risk before reward. As Warren Buffett famously said, Rule number 1, never lose money. Rule number 2, never forget rule number 1. At first glance, this statement may appear impossible. After all, every investor experiences losses from time to time. But the deeper meaning of this rule is simple. Avoid large and permanent losses that destroy your capital. Small mistakes can be recovered. Large mistakes can end the journey completely. Imagine an investor who loses half of their capital. Recovering from such a loss becomes extremely difficult. A loss of half requires a gain of double just to return to the starting point. This is why protecting capital is far more important than chasing rapid gains. Many investors lose money because they fall in love with excitement. They chase trending stocks, dramatic predictions, and stories of overnight success. They buy without understanding the business behind the stock. They invest because others are buying, not because the investment makes sense. This behavior often leads to painful outcomes. The market does not reward excitement, it rewards discipline and thoughtful decisions. One powerful idea introduced by Benjamin Graham is the concept of a margin of safety. The margin of safety means investing in situations where risk is reduced and the probability of success is higher. It is like building a bridge that can carry much more weight than necessary. Even if unexpected pressure appears, the bridge remains strong. In investing, this protection can come from buying strong businesses at reasonable prices. It can come from avoiding excessive debt. It can come from understanding the company before committing capital. Protection also means avoiding reckless behavior. Some investors trade constantly. They react to every news headline and every price movement. They believe constant action is the path to success. In reality, frequent activity often increases mistakes and costs. Calm investors do not rush. They observe carefully. They act only when the opportunity is clear and sensible. Protecting capital also requires emotional control. When markets fall sharply, fear spreads quickly. Prices drop and investors panic. Many sell their investments at the worst possible moment. During rising markets, the opposite emotion appears. Greed grows stronger. Investors begin to believe that prices will rise forever. Both reactions can destroy capital. Successful investors learn to remain steady during both excitement and fear. They understand that markets move in cycles. Booms and downturns are natural parts of the journey. Another important part of protecting capital is diversification. No investor can predict the future perfectly. Unexpected events always occur. By spreading investments across different companies and industries, risk becomes more manageable. One mistake will not destroy the entire portfolio. Protection also comes from patience. Many investors rush into opportunities without careful thinking. They fear missing out on profits, but the market offers opportunities again and again over time. A patient investor understands that waiting is often the best decision. Charlie Munger once explained this idea clearly. He said the big money is not in constant buying and selling, but in waiting for the right opportunity. Patience acts like a shield against unnecessary risk. Over time, investors who focus on protecting capital begin to notice something interesting. Their wealth grows more steadily. Their stress becomes lower. Their decisions become clearer. Instead of chasing every opportunity, they concentrate on avoiding major mistakes. And avoiding big mistakes is often the secret to long-term success. The market rewards those who stay in the game for many years, but only those who protect their capital can remain in the game long enough to benefit from compounding. Once an investor understands how to protect capital, the next step becomes equally important. Protection alone is not enough. An investor must also learn where to place capital wisely. This brings us to the second rule of the investor's shield. Rule 2. Understand what you invest in. After learning to protect capital, the next step in building the investor's shield is understanding. Protection keeps you in the game. Understanding helps you play the game wisely. Many investors lose money not because the market is unfair, but because they invest in things they do not understand. They follow tips from friends, they listen to confident predictions from strangers. They chase popular trends that everyone seems to be talking about. In such moments, investing stops being a thoughtful decision and becomes a form of gambling. A wise investor does something different. Before investing money, they first invest time in understanding. As Peter Lynch once said, "Know what you own and know why you own it." These words carry deep wisdom. When you understand an investment, you gain clarity. When you gain clarity, you develop patience. And patience is one of the greatest advantages an investor can have. Think about what a stock really represents. A stock is not simply a moving number on a screen. It represents partial ownership of a real business. That business has employees, products, customers, competitors, and challenges. Its success depends on the value it creates in the real world. When you buy shares of a company, you are becoming a small partner in that business. This is why legendary investors always think like business owners rather than traders. Before investing, they ask important questions. What does the company actually do? How does the company make money? Why do customers choose its products? Does the business have strong leadership? Can the company grow in the future? These questions help investors see beyond price movements. They reveal the true strength or weakness of a business. One of the greatest teachers of this philosophy was Benjamin Graham. Graham encouraged investors to treat stocks as ownership in businesses rather than as objects of speculation. When investors forget this principle, they begin to behave like gamblers. They buy because the price is rising. They sell because the price is falling. Their decisions become reactions instead of thoughtful judgments. Understanding transforms this behavior. When you truly understand a business, temporary market movements become less frightening. You focus on the long-term strength of the company rather than the daily noise of the market. For example, imagine owning a small bakery in your neighborhood. You would not panic if someone offered a lower price for your bakery one day. You would think about the quality of your bread, the loyalty of your customers, and the long-term success of the business. Investing in stocks should follow the same logic. The market may offer different prices every day, but the real value of the business changes slowly over time. Understanding also helps investors avoid dangerous situations. Some companies appear exciting on the surface. They promise rapid growth and revolutionary ideas. Their stories attract attention and excitement. But beneath the surface, the business may be weak, profits may be uncertain, debt may be dangerously high. Without understanding the business, investors may mistake excitement for quality. This is why Warren Buffett often speaks about staying within what he calls the circle of competence. The circle of competence simply means investing in areas you understand well. No one can understand every industry. Technology, healthcare, finance, energy, and many other sectors each have their own complexities. A wise investor does not try to master everything. Instead, they focus on areas where their understanding is strong. Inside this circle of competence, decisions become clearer and risks become easier to evaluate. Outside this circle, uncertainty increases. Understanding also builds emotional strength. When markets become volatile, investors who lack knowledge often panic. They sell during fear and regret the decision later. But investors who understand their businesses remain calmer. They know why they invested and what they expect from the company over time. This confidence allows them to stay patient when others become emotional. Another benefit of understanding is independence. When you understand an investment, you do not need constant reassurance from others. You are not easily influenced by rumors, headlines, or social media excitement. Your decisions come from knowledge rather than noise. This independence is a powerful advantage in the stock market. Markets often move based on emotion and crowd behavior. Those who think independently can avoid many of the mistakes that crowds make. Over time, the habit of understanding businesses develops a strong investing mindset. Instead of chasing opportunities, you evaluate them carefully. Instead of reacting to price changes, you focus on real value. This mindset creates the foundation for wise investing. Once an investor understands how to protect capital and how to understand investments, a new and powerful perspective begins to emerge. The investor stops seeing stocks as symbols and numbers. They begin to see them as real businesses with real value. This realization leads directly to the next rule of the investor's shield. Rule 3. Think like a business owner. After learning to protect capital and understand investments, the next step in building the investor's shield is changing the way you think about stocks. Many people enter the stock market with the mindset of a trader. They watch prices constantly. They focus on daily movements. They celebrate when prices rise and panic when prices fall. But successful investors develop a different mindset. They do not think like gamblers or speculators. They think like business owners. A stock is not just a number moving on a screen. It represents ownership in a real company. When you buy a share of a company, you become a partial owner of that business. You share in its profits, its growth, and its challenges. Understanding this simple truth changes everything about how an investor behaves. Imagine that you own a small restaurant in your town. Every day, customers come in to enjoy meals. The business earns income and slowly grows its reputation. Now imagine that someone comes to you every day and offers to buy your restaurant at a different price. Some days the offer is high. Some days the offer is low. Would you sell your restaurant simply because the offer changed today? Of course not. You would think about the long-term success of the business. You would think about the quality of your food, the loyalty of your customers, and the future growth of your restaurant. Stock investing should follow the same logic. Daily price movements are simply offers from the market. They do not define the real value of a company. This idea was explained beautifully by Benjamin Graham. He once said that in the short run, the market behaves like a voting machine, but in the long run, it behaves like a weighing machine. In the short term, prices move based on popularity, excitement, and fear. In the long term, prices reflect the true strength of the business. This is why great investors spend more time studying businesses than watching stock prices. They look at the company's products and services. They examine the strength of management. They evaluate how the business competes with others. These factors reveal whether a company has the ability to grow over many years. One of the most successful investors in history, Warren Buffett, often describes himself not as a stock picker, but as a business owner. When Buffett buys shares of a company, he imagines owning the entire business. He asks whether the company will remain strong 10 years into the future. This long-term perspective protects investors from many common mistakes. For example, when investors focus only on price, they may become excited about companies with rapidly rising stocks, but price alone does not guarantee quality. Some companies rise quickly because of hype or speculation. Their business foundations may be weak. A business owner would never buy a company simply because its price is rising. A business owner would study the quality of the business itself. Thinking like an owner also encourages patience. Real businesses grow slowly through innovation, customer relationships, and strong management. They do not transform overnight. Investors who expect instant results often become disappointed. But those who think like owners understand that true growth takes time. This mindset also helps investors remain calm during market declines. When prices fall, traders often panic. They see falling numbers and assume disaster. But an owner asks a different question. Has the business itself changed? If the company continues to grow, serve customers, and create value, then a temporary decline in price may simply represent a market reaction rather than a true problem. In some cases, falling prices even create opportunities to buy strong businesses at better valuations. Thinking like a business owner also encourages deeper curiosity. You begin to ask meaningful questions about the companies you invest in. What makes this business unique? Does it have loyal customers? Does it have a competitive advantage that protects it from rivals? Can it continue growing in the future? These questions shift your focus away from short-term speculation and toward long-term value creation. Over time, this approach builds confidence and clarity. Instead of reacting emotionally to market movements, you evaluate businesses calmly and logically. The investor who thinks like an owner becomes less influenced by noise, rumors, and short-term excitement. Their decisions become more thoughtful and disciplined. And discipline is one of the greatest strengths an investor can possess. However, even the strongest businesses require one more important quality from investors: time. Great companies often grow steadily over many years, but only patient investors benefit from this growth. This leads us to the next rule of the investor's shield. Rule 4. Patience is a powerful advantage. After learning to think like a business owner, the next rule of the investor's shield teaches one of the most powerful qualities in investing. That quality is patience. Many people believe that success in the stock market comes from speed. They think the best investors are always buying, always selling, and constantly reacting to new information. But history shows a very different reality. The greatest investors often succeed not because they act more, but because they act less. They wait calmly for the right opportunities and allow time to do most of the work. The stock market constantly tempts investors to take action. Prices move every minute. Financial news appears every hour. Experts offer endless predictions about what will happen next. All of this activity creates the feeling that something must always be done. But wise investors understand that activity and progress are not the same thing. Sometimes the most intelligent decision is simply to wait. One of the most respected investors in the world, Charlie Munger, once explained this idea clearly. He said the big money is not in the buying or the selling, but in the waiting. Waiting may sound passive, but in reality it requires great discipline. Patience protects investors from impulsive decisions. It prevents them from chasing every exciting opportunity that appears in the market. Opportunities in the stock market appear in cycles. There are times when prices become too high because of excitement and optimism. There are also times when prices become very low because of fear and pessimism. The patient investor watches these cycles calmly. They do not rush into overpriced situations. Instead, they wait until strong businesses become available at reasonable prices. This patience creates a powerful advantage. Many investors lose money because they cannot tolerate waiting. They feel uncomfortable when their money is not constantly moving. They believe that if they are not trading frequently, they are missing opportunities, but frequent trading often leads to higher costs, more mistakes, and emotional decisions. Patience also works together with one of the most powerful forces in investing. That force is compounding. Compounding occurs when investments generate returns, and those returns begin to generate their own returns over time. The longer money remains invested in strong businesses, the more powerful this process becomes. A small investment can grow into something extraordinary if given enough time. But compounding requires patience. Investors who constantly move their money from one opportunity to another interrupt the compounding process. Instead of allowing wealth to grow steadily, they reset the process again and again. This is why many successful investors hold their best investments for many years. The legendary investor Warren Buffett once described his favorite holding period with a single word. He said his favorite holding period is forever. This statement does not mean that investors should never sell. It means that great businesses often continue creating value for very long periods of time. Patient investors allow that value to accumulate. Patience also protects investors during difficult market conditions. Markets do not rise in a straight line. There are periods of decline, uncertainty, and fear. During these times, impatient investors often abandon their strategy. They sell their investments in panic and lock in their losses. Patient investors behave differently. They understand that downturns are natural parts of the market cycle. They focus on the long-term strength of their businesses rather than short-term market emotions. Over time, history has shown that markets recover and continue moving forward. Those who remain patient during difficult periods often benefit when recovery begins. Patience also gives investors the opportunity to learn and improve. Instead of reacting quickly to every market movement, patient investors spend time studying businesses, understanding industries, and refining their strategy. Their decisions become more thoughtful and informed. In this way, patience becomes more than just waiting. It becomes a powerful strategy for long-term success. The investor who develops patience gains something extremely valuable. They gain control over their actions and emotions. Instead of being pulled in every direction by market noise, they remain steady and focused. But patience alone is not enough to protect an investor from all dangers. Even patient investors must face one of the most powerful forces in the financial world. That force is emotion. Fear and greed have influenced markets for centuries, and they continue to influence them today. Learning to recognize and control these emotions becomes the next layer of the investor's shield. This leads us to the next rule, Rule 5. Avoid emotional decisions. After learning the power of patience, the next rule of the investor's shield focuses on one of the greatest dangers in investing. That danger is emotion. The stock market is not only a place where money moves, it is also a place where human emotions appear every day. Fear, greed, hope, excitement, and regret constantly influence the decisions of investors. Prices often rise and fall not only because of business performance, but because of how people feel about the future. Understanding this truth is extremely important. The market tests emotional strength again and again. Those who allow emotions to control their decisions often make costly mistakes. Those who learn to control emotions gain a powerful advantage. One of the most respected investors in history, Benjamin Graham, once explained this challenge clearly. He said the investor's greatest enemy is often not the market, but himself. Human nature pushes investors toward emotional behavior. When prices rise quickly, excitement spreads everywhere. News headlines celebrate the rising market. Friends begin talking about easy profits. In these moments, greed begins to grow. Investors start believing that prices will continue rising forever. They rush into the market without careful thinking. They buy companies they barely understand simply because everyone else is buying. History has shown that this behavior often appears near market peaks. Then the cycle changes. Prices begin to fall. Negative news spreads quickly. Fear replaces excitement. Investors begin to imagine the worst possible outcomes. They sell their investments in panic, often at the lowest prices. This pattern has repeated itself many times throughout financial history. Greed pushes investors to buy when prices are high. Fear pushes them to sell when prices are low. The result is the opposite of successful investing. Successful investors learn to recognize these emotional traps. They understand that markets move through cycles of optimism and pessimism. They know that emotional extremes often create misleading signals. During times of great excitement, wise investors become cautious. During times of deep fear, wise investors begin searching for opportunities. This calm behavior requires emotional discipline. One famous observation from Warren Buffett captures this idea perfectly. He advised investors to be fearful when others are greedy, and greedy when others are fearful. This statement does not encourage reckless behavior. Instead, it reminds investors to remain calm when the crowd becomes emotional. Avoiding emotional decisions also requires a clear strategy. When investors lack a plan, they are more easily influenced by market movements. They react to headlines, rumors, and sudden price changes. But when investors have a clear strategy, their decisions become more stable. They know why they bought a company. They know what they expect from it over time. They know the conditions that would cause them to sell. This clarity reduces emotional reactions. Another helpful practice is focusing on long-term outcomes rather than short-term movements. Daily price fluctuations are often unpredictable. They can create unnecessary stress and confusion. But the long-term success of a strong business depends on its ability to create value for customers and generate profits. Investors who focus on this long-term perspective are less affected by temporary market emotions. Emotional discipline also improves decision-making. When fear or greed dominates the mind, clear thinking becomes difficult. Investors may ignore risks, overlook important information, or make impulsive decisions. But when the mind is calm, judgment becomes clearer. This calm state allows investors to evaluate opportunities logically rather than emotionally. Another important benefit of emotional control is consistency. Successful investing is rarely about a single brilliant decision. It is about making many good decisions over a long period of time. Emotional reactions often break this consistency. By learning to observe emotions without acting on them immediately, investors develop a stronger and more disciplined mindset. They become less influenced by market noise and more focused on long-term value. Over time, this emotional stability becomes one of the strongest protections an investor can have. However, even the most disciplined investors must accept an important reality. The future is always uncertain. Unexpected events can affect even the strongest companies. Because of this uncertainty, wise investors build another layer of protection into their strategy. They avoid placing all their hopes on a single investment. Instead, they spread their risk across different opportunities. This idea introduces the next rule of the investor's shield. Rule 6. Diversification is your safety net. After learning to control emotions, the next rule of the investor's shield introduces another powerful form of protection. That protection is diversification. Investing always involves uncertainty. No matter how carefully you study a company, the future can never be predicted with complete certainty. Unexpected events can appear at any time. Economic changes, technological shifts, new competitors, or global crises can affect even strong businesses. Because of this uncertainty, wise investors avoid placing all their capital into a single investment. Instead, they spread their investments across multiple companies and industries. This practice is known as diversification. Diversification acts like a safety net for your portfolio. If one investment performs poorly, the others can help balance the overall result. Without diversification, a single mistake can cause severe damage to an investor's capital. Imagine a farmer who plants only one type of crop across an entire field. If weather conditions damage that crop, the farmer loses the entire harvest. But if the farmer plants several different crops, the risk becomes more balanced. Even if one crop fails, the others may still succeed. Investing follows a similar principle. By owning several businesses in different industries, investors reduce the impact of unexpected problems. The concept of diversification was explained clearly by Benjamin Graham. He encouraged investors to spread their investments across multiple companies to reduce risk and increase stability. Diversification does not eliminate risk completely, but it reduces the chance that a single error will destroy an entire portfolio. Another benefit of diversification is balance. Different industries often perform well during different economic conditions. For example, technology companies may grow rapidly during periods of innovation. Consumer goods companies may remain stable during economic uncertainty. Healthcare companies may continue growing because people always need medical care. By holding investments across several sectors, investors create a more balanced portfolio that can adapt to changing conditions. However, diversification must be practiced wisely. Owning too many investments without understanding them can create confusion rather than protection. Some investors believe that holding dozens of companies automatically guarantees safety. But if those investments are poorly chosen, the portfolio may still perform poorly. Effective diversification combines two important ideas: careful selection and thoughtful balance. Each investment should still meet the standards of quality, understanding, and long-term potential. The legendary investor Warren Buffett once explained diversification in a thoughtful way. He suggested that diversification is protection against ignorance. This statement does not criticize diversification itself. Instead, it highlights the importance of understanding investments. If an investor understands only a few businesses deeply, diversification helps protect against mistakes. But if an investor truly understands a business with strong confidence, they may choose to invest more heavily in that opportunity. For most investors, diversification remains a wise and practical strategy. It creates stability and reduces the emotional pressure caused by large losses in a single investment. Diversification also encourages patience. When investors rely on a single stock, every price movement can feel extremely important. A decline may create panic, while a rise may create excessive excitement. But when investments are spread across several companies, short-term movements in one position become less stressful. This emotional balance allows investors to think more clearly and make better decisions. Another advantage of diversification is learning. By investing in different industries, investors gain broader knowledge about the economy and business world. They begin to understand how different sectors grow, compete, and respond to change. This knowledge improves future investment decisions. Diversification also reminds investors of an important truth. No one can predict the future perfectly. Even the most experienced investors occasionally make mistakes. Diversification accepts this reality and prepares for it. Instead of trying to achieve perfect predictions, diversified investors focus on building a portfolio that can survive different scenarios. Over time, this balanced approach often produces steadier and more reliable results. But diversification alone does not guarantee long-term success. For wealth to grow meaningfully, investors must also recognize another powerful factor. That factor is time. Strong businesses often expand their profits slowly and steadily over many years. Investors who remain invested during this growth can benefit from the compounding power of time. Understanding this relationship between business growth and time leads us to the next rule of the investor's shield. Rule 7. Time is the friend of great businesses. After learning the importance of diversification, the next rule of the investor's shield introduces one of the most powerful allies an investor can have. That ally is time. Many investors enter the market hoping for quick success. They imagine rapid profits and dramatic gains within a short period. This expectation often leads to disappointment and frustration. True investing works very differently. Great businesses usually grow slowly and steadily over many years. Their profits increase gradually as they improve products, expand services, and build stronger relationships with customers. This steady progress may not appear exciting in the short term, but over long periods it can create extraordinary results. Time allows strong businesses to reveal their true strength. It allows management decisions to shape the future of the company. It allows innovation and customer trust to build lasting value. Investors who understand this principle learn to think in years rather than days. Daily price movements become less important. What matters more is the long-term growth of the business itself. One of the most famous explanations of long-term investing comes from Warren Buffett. He often explains that the ideal holding period for a great business can be extremely long. This perspective reflects deep confidence in the power of time and business growth. Strong companies often possess advantages that help them succeed over many years. They may have loyal customers, trusted brands, efficient operations, or innovative products. These advantages allow the business to generate consistent profits and reinvest those profits into future growth. Over time, this process creates a powerful cycle. The company earns profits. Those profits are reinvested into the business. The reinvestment creates more growth and even greater profits. This cycle repeats year after year. For patient investors, this long-term growth becomes the foundation of wealth creation. Another important force works together with time. That force is compounding. Compounding occurs when investment returns begin generating their own returns. Small gains accumulate, and those gains begin producing additional gains in the future. The longer this process continues, the stronger it becomes. Even modest growth can become extraordinary when it continues for many years. The concept of compounding has fascinated many thinkers throughout history. The famous scientist Albert Einstein once described compound growth as a remarkably powerful force. Although the statement is often repeated in different ways, the message remains clear. Compounding becomes extremely powerful when combined with patience and time. Unfortunately, many investors interrupt this process. They buy a good investment, but sell it too quickly because they want faster results. They move from one opportunity to another, hoping to find immediate profits. Each time they do this, they restart the compounding process. Instead of allowing wealth to grow steadily, they constantly reset their progress. Patient investors behave differently. They identify strong businesses and allow time to do the work. They resist the temptation to react to every short-term market movement. This patience allows the business to grow and compound its value. Time also helps investors navigate market cycles. Financial markets naturally move through periods of optimism and pessimism. There are times when prices rise quickly and enthusiasm spreads everywhere. There are also times when fear dominates and prices decline sharply. Investors who focus only on short-term movements often become discouraged during downturns. But investors who understand the power of time recognize that temporary declines are part of the journey. Strong businesses continue operating, innovating, and serving customers even when market prices fall. As long as the business remains healthy, time often allows recovery and future growth. Another benefit of time is learning. Long-term investors gain experience through different market conditions. They observe booms, corrections, recoveries, and technological changes. Each experience improves their understanding of markets and businesses. Over the years, this accumulated knowledge becomes extremely valuable. Time transforms beginners into experienced investors who can recognize opportunities and avoid common mistakes. However, time can only work effectively when investors remain focused on the right things. Many investors become distracted by daily market noise. Financial news, social media discussions, and constant predictions create endless distractions. These distractions can pull investors away from their long-term strategy. To benefit from the power of time, investors must learn to filter out unnecessary noise. They must focus on meaningful information rather than daily excitement. This idea leads naturally to the next rule of the investor's shield. Rule 8. Ignore the noise. After understanding that time helps great businesses grow, the next rule of the investor's shield teaches investors how to protect their focus. That protection comes from ignoring unnecessary noise. The modern financial world is filled with information. Every day, investors hear countless predictions, opinions, and dramatic headlines. Financial television channels broadcast market discussions from morning until night. Websites publish endless articles about the latest trends and predictions. Social media spreads rumors and excitement at incredible speed. At first, this information may appear useful. It feels as if more information should lead to better decisions. But in reality, much of this information is simply noise. Noise is information that creates distraction rather than clarity. It captures attention but rarely improves long-term decision-making. The stock market naturally attracts noise because prices change every day. A small movement in price quickly becomes a news story. Experts appear to explain why the market moved and what may happen next. But the truth is that short-term market movements are often unpredictable. Many daily changes happen because of temporary emotions, rumors, or random events. Trying to react to every movement often leads investors into unnecessary actions. The disciplined investor understands this challenge. Instead of reacting to every headline, they focus on information that truly matters. They study the long-term performance of businesses. They evaluate financial strength, management quality, and competitive advantages. These factors shape the future of a company far more than daily market commentary. The legendary investor Warren Buffett has often spoken about the importance of ignoring unnecessary noise. He prefers to spend his time studying businesses rather than watching stock prices constantly. This calm approach allows him to make thoughtful decisions without being influenced by daily excitement. Noise often becomes most dangerous during periods of extreme optimism or extreme fear. During rising markets, headlines celebrate success and predict endless growth. Stories of rapid wealth appear everywhere. Investors feel pressure to join the excitement before they miss the opportunity. This excitement can lead to careless decisions. Investors may buy companies without proper understanding simply because everyone else appears to be doing the same. Then the cycle changes. When markets decline, negative headlines begin to dominate the news. Predictions of economic disaster appear frequently. Fear spreads quickly among investors. In these moments, many people sell their investments simply to escape the feeling of uncertainty. Both reactions are influenced more by noise than by thoughtful analysis. Wise investors learn to recognize these emotional waves without being controlled by them. One helpful reminder comes from Benjamin Graham. Graham described the market as a partner who offers different prices every day. Sometimes the partner is optimistic and offers high prices. Sometimes the partner is pessimistic and offers low prices. The intelligent investor does not follow the partner's mood. Instead, they use those price changes only when it benefits them. Ignoring noise does not mean ignoring information completely. Important developments within a company or an industry should always be studied carefully. But there is a difference between meaningful information and endless speculation. Meaningful information helps investors understand the long-term strength of a business. Noise simply creates emotional reactions and unnecessary activity. Another danger of noise is that it encourages constant trading. When investors hear predictions every day, they feel pressure to act quickly. They buy one stock today and sell it tomorrow based on the latest opinion. Frequent trading increases costs and often leads to mistakes. Patient investors understand that true investing rarely requires constant action. Once a strong business is chosen, time and compounding often become the most powerful drivers of growth. Ignoring noise also improves emotional stability. When investors constantly follow market headlines, they experience every wave of excitement and fear. Their emotions rise and fall with each price movement. But investors who step away from constant news often feel calmer and more focused. They can concentrate on long-term strategy rather than daily fluctuations. This calm mindset leads to better decision-making. Instead of reacting impulsively, disciplined investors evaluate opportunities slowly and thoughtfully. Over time, the ability to ignore noise becomes one of the greatest advantages an investor can develop. While the crowd reacts to every headline, the disciplined investor remains steady and focused on long-term value. However, ignoring noise leads to another important question. If investors should not chase every exciting story in the market, what should they focus on instead? The answer lies in choosing businesses with strong foundations and lasting value. This idea leads to the next rule of the investor's shield. Rule 9. Buy quality over hype. After learning to ignore market noise, the next rule of the investor's shield teaches investors where to place their attention. That focus should always be on quality rather than hype. The stock market often celebrates excitement. New technologies, bold predictions, and dramatic stories attract enormous attention. Companies surrounded by excitement often experience rapid rises in their stock prices. Investors watching these movements may feel tempted to join the excitement. They fear missing an opportunity that everyone else seems to be chasing. But excitement and quality are not the same thing. Hype grows quickly. Quality grows slowly. Hype is driven by stories and expectations about the future. Quality is built through real performance, real customers, and real profits. The disciplined investor learns to recognize this difference. Throughout financial history, many companies have captured public attention with ambitious promises. Some of those companies eventually succeeded, but many others disappeared once the excitement faded. Investors who chased hype often discovered that stories alone cannot create lasting value. Quality businesses, on the other hand, follow a very different path. They focus on solving real problems for customers. They build products and services that people trust and rely on. They develop strong reputations and loyal customer bases over time. These companies may not always appear exciting in the short term. Their progress may seem slow compared to companies surrounded by hype. But over many years, their steady growth often creates remarkable results. One of the most important principles of long-term investing was taught by Warren Buffett. He often explains that it is far better to buy a wonderful company at a fair price than to buy a mediocre company at a cheap price. This idea emphasizes the power of quality. A strong company can continue growing for many years. It can increase profits, expand into new markets, and strengthen its competitive advantages. A weak company, even if purchased at a low price, may struggle to grow or may eventually decline. Quality businesses often possess certain characteristics that help them succeed over long periods. They may have strong brands that customers trust. They may produce products that people use regularly. They may operate efficiently and manage their finances carefully. Most importantly, they usually possess some form of competitive advantage. A competitive advantage allows a company to stand out from its competitors. It protects the business from being easily replaced. For example, a company may have superior technology, trusted brand recognition, or a powerful distribution network. These advantages make it difficult for competitors to take away customers. The legendary investor Charlie Munger often emphasized the importance of these durable advantages. He believed that investing in strong businesses with lasting advantages greatly increases the probability of long-term success. Another sign of quality is consistent financial performance. Strong companies often generate steady profits year after year. They manage their expenses carefully and maintain healthy financial structures. This stability allows them to survive economic challenges and continue growing over time. In contrast, companies driven mainly by hype often show unstable financial performance. Their growth may depend heavily on optimistic expectations rather than proven results. When expectations change, their stock prices may fall dramatically. Investors who focus on quality avoid many of these risks. They examine the company's history, financial strength, and competitive position. They ask whether the business will likely remain strong many years into the future. This approach requires patience and discipline. Quality businesses are not always the most exciting investments at the moment they are purchased, but their long-term performance often rewards patient investors. Buying quality also supports emotional stability. When investors own strong companies, they feel more confident holding their investments during difficult market periods. They understand the value of the business behind the stock. This confidence reduces the temptation to react to short-term market noise. Over time, focusing on quality builds a portfolio of strong businesses that can grow steadily for many years. However, even the most careful investors must accept an important truth. No investor makes perfect decisions all the time. Mistakes are a natural part of the investing journey. What truly matters is how investors respond to those mistakes. This realization introduces the next rule of the investor's shield. Rule 10. Accept that mistakes are part of the journey. After learning to focus on quality businesses, the next rule of the investor's shield introduces an important truth about investing. Mistakes are unavoidable. Many beginners believe that successful investors always make perfect decisions. They imagine that great investors rarely experience losses. This belief is far from reality. Even the most respected investors in history have made mistakes. They have invested in companies that failed. They have missed opportunities that later became extremely successful. The difference between successful investors and unsuccessful ones is not the absence of mistakes. The difference is how they respond to those mistakes. Wise investors treat mistakes as teachers rather than enemies. When a decision turns out poorly, they study the experience carefully. They ask what went wrong and what could be improved in the future. This process transforms mistakes into valuable lessons. One of the greatest investors of modern times, Warren Buffett, has often spoken openly about his investment errors. Throughout his long career, he has admitted several decisions that did not work as expected. Instead of hiding these mistakes, he uses them to explain the importance of learning and discipline. This honesty reveals a powerful truth. Perfection is not required for long-term investing success. What matters more is avoiding large and repeated mistakes. Small errors are part of the learning process. But large mistakes that destroy capital can delay progress for many years. That is why the earlier rules of the investor's shield focus on protection, understanding, patience, and discipline. These principles reduce the risk of catastrophic errors. Another important lesson from mistakes is humility. The stock market constantly reminds investors that the future cannot be predicted with perfect accuracy. No matter how intelligent or experienced someone becomes, uncertainty always remains. This reality encourages investors to remain humble and cautious. The legendary investor Benjamin Graham believed that investing should always include a margin of safety. This concept protects investors from the natural possibility of mistakes. When investments are made with careful judgment and a margin of safety, errors become less damaging. Humility also encourages investors to remain open to new information. If a company's situation changes or new facts appear, wise investors reconsider their original assumptions. They are willing to adjust their decisions rather than stubbornly defending a mistake. Stubbornness can turn a small error into a large disaster. Learning from mistakes also strengthens emotional resilience. Investing can sometimes feel uncomfortable when decisions do not work as expected. Prices may decline or opportunities may be missed, but investors who accept mistakes as part of the journey remain calmer during these moments. They understand that progress comes from experience and continuous improvement. Over time, these lessons accumulate. Each experience adds a new layer of understanding about markets, businesses, and human behavior. Gradually, the investor becomes wiser and more disciplined. Another important aspect of learning from mistakes is record keeping. Many experienced investors keep notes about their decisions. They record why they invested in a company and what they expected to happen. Later, they review these notes to evaluate their thinking. This habit helps them identify patterns in their decisions. It reveals strengths as well as weaknesses in their investment process. Over time, this reflection improves judgment and decision-making. Mistakes also remind investors that investing is a long journey rather than a single event. A single decision rarely determines the entire outcome of an investing career. Instead, long-term success comes from many decisions made across many years. Some decisions will succeed, others will fail. But as long as investors continue learning and improving, their overall progress can remain positive. This mindset turns investing into a process of continuous development. Each mistake becomes a step toward greater understanding. However, even when investors learn from mistakes, another challenge still remains. Investment returns can quietly shrink because of an often overlooked factor. That factor is cost. Frequent trading, high fees, and unnecessary expenses can slowly reduce the growth of a portfolio. Understanding how to control these hidden costs becomes the next layer of protection in the investor's shield. This leads us to the next rule. Rule 11. Keep costs low. After understanding that mistakes are part of the journey, the next rule of the investor's shield focuses on a danger that many investors overlook. That danger is cost. Costs in investing often appear small and harmless. A small commission here, a small fee there, a little tax after a trade. Each individual cost may seem insignificant, but over time these small costs can quietly reduce the growth of an investment portfolio. Investing is not only about how much money you earn, it is also about how much money you keep. Every time an investor trades frequently, pays high management fees, or enters complex financial products with hidden charges, a portion of potential returns disappears. These costs may not be obvious at first, But when they accumulate year after year, they can significantly slow the growth of wealth. The importance of low costs was strongly emphasized by John C. Bogle, the founder of Vanguard and a pioneer of low-cost investing. Bogle often explained that investors should pay close attention to expenses because costs are one of the few factors they can fully control. Markets may rise or fall, economic conditions may change, but investors can always decide whether they want to pay high fees or keep costs low. Keeping costs low begins with reducing unnecessary trading. Many investors believe that frequent trading increases their chances of profit. They buy and sell constantly, reacting to market movements and predictions. But each trade usually involves commissions, taxes, and potential mistakes. Frequent trading often creates more expenses than benefits. Patient investors behave differently. They select investments carefully and hold them for longer periods. This approach reduces transaction costs and allows investments to grow without constant interruptions. Lower costs also mean that a greater portion of investment returns remains in the portfolio. Over time, this difference can become surprisingly large. For example, imagine two investors earning the same market returns. One investor pays high fees every year, while the other keeps expenses minimal. After many years, the investor with lower costs often ends up with significantly more wealth simply because less money was lost to fees. Costs also appear in the form of complex financial products. Some investment products promise impressive results, but include layers of management fees, performance charges, and hidden expenses. These products may appear sophisticated, but complexity often hides additional costs. Wise investors approach such products with caution. They prefer investments that are simple, transparent, and easy to understand. Simplicity reduces both financial costs and decision-making errors. Another hidden cost comes from emotional trading. When investors react emotionally to market movements, they often buy at high prices and sell at low prices. This behavior creates a cost that is not always visible on paper but can greatly damage long-term returns. Emotional decisions interrupt the compounding process and reduce the effectiveness of long-term investing. Keeping costs low also requires discipline during periods of excitement in the market. When markets rise quickly, investors may feel tempted to chase new opportunities constantly. They move money from one investment to another, hoping to capture faster gains. But this activity usually increases both financial costs and risk. Disciplined investors understand that wealth often grows through patience rather than constant action. The legendary investor Warren Buffett has often expressed admiration for strategies that keep costs low and allow compounding to work over long periods. He frequently reminds investors that simple and disciplined approaches can outperform complex strategies burdened with high fees. Another advantage of low costs is peace of mind. When investors know that their strategy is efficient and inexpensive, they feel less pressure to chase extraordinary returns. They can focus on steady long-term growth rather than constant activity. This calm approach often leads to better decision-making. Low-cost investing also aligns perfectly with the earlier rules of the investor's shield. It supports patience by reducing the need for frequent trading. It supports discipline by encouraging long-term thinking. It supports emotional control by discouraging impulsive decisions. Over time, the investor who keeps costs low gives compounding the opportunity to operate more effectively. More of the investment returns remain in the portfolio and continue growing year after year. However, even when costs are controlled, another important shift in mindset is required for long-term success. Investors must learn to focus less on short-term price movements and more on the long-term growth of their investments. This perspective leads to the next rule of the investor's shield. Rule 12. Focus on long-term growth. After learning the importance of keeping costs low, the next rule of the investor's shield teaches investors where their attention should truly be placed. That focus is long-term growth. Many people enter the stock market hoping to make quick profits. They watch daily price movements closely. They celebrate when prices rise and worry when prices fall. This short-term focus can easily create stress and confusion. The reality is that daily market movements are often unpredictable. Prices can rise or fall for many temporary reasons such as news, rumors, economic reports, or changes in investor sentiment. Trying to predict every short-term movement is extremely difficult, even for experienced professionals. Wise investors therefore shift their attention away from short-term fluctuations. Instead, they focus on the long-term growth of strong businesses. A business grows through innovation, customer satisfaction, and effective management. These factors develop gradually over time rather than overnight. When investors focus on long-term growth, they begin to evaluate companies differently. Instead of asking what the price may do tomorrow, they ask deeper questions. Will this business remain valuable many years from now? Can the company continue expanding its products or services? Does it possess advantages that help it compete successfully? These questions guide investors toward companies capable of sustained progress. The philosophy of long-term investing has been explained clearly by Warren Buffett. Buffett often emphasizes that investors should imagine owning a business for many years rather than treating stocks as short-term trading instruments. This perspective changes the entire approach to investing. When the focus is long-term growth, temporary market volatility becomes less frightening. Short-term declines may appear disappointing, but they often have little impact on the long-term strength of a great business. In fact, periods of market decline can sometimes create opportunities to purchase strong companies at attractive prices. Long-term investors recognize that market cycles are natural. Throughout history, the market has experienced expansions, corrections, recessions, and recoveries. Each cycle brings different challenges and opportunities. Investors who focus only on short-term movements often react emotionally during these cycles. They buy during periods of excitement and sell during moments of fear. But investors who concentrate on long-term growth behave differently. They evaluate whether the underlying business remains strong. If the company continues growing and serving customers successfully, temporary market movements become less important. Another powerful advantage of long-term thinking is the ability to benefit from compounding. Compounding allows investment returns to generate additional returns over time. The longer this process continues, the more powerful it becomes. A company that grows steadily year after year can create remarkable results for patient investors. This is why long-term investors often prefer businesses with durable competitive advantages. Such companies can maintain profitability and growth for extended periods. Their ability to reinvest profits into future expansion strengthens their long-term potential. The concept of long-term thinking was strongly supported by Benjamin Graham. Graham believed that the true value of a company becomes visible over time as the business continues to generate earnings and build financial strength. Short-term market movements may hide this value temporarily, but patient investors eventually see the results. Long-term growth also encourages emotional stability. When investors constantly monitor short-term price movements, they often experience frequent emotional reactions. Each rise creates excitement, and each decline creates anxiety. But investors who focus on long-term progress develop a calmer perspective. They understand that meaningful growth requires patience and consistency. This calm mindset helps investors remain disciplined during both market booms and downturns. Long-term thinking also improves decision-making. When investors extend their time horizon, they naturally become more selective about the businesses they choose. They seek companies with strong fundamentals, capable leadership, and sustainable advantages. This careful selection increases the probability of success over many years. Gradually, the investor begins to see the market differently. Instead of a place for rapid speculation, the market becomes a place where ownership in growing businesses can create lasting wealth. However, understanding long-term growth also requires awareness of the past. Markets have experienced many cycles, bubbles, and recoveries throughout history. These historical events contain valuable lessons for investors. Learning from these lessons can help investors avoid repeating costly mistakes. This insight leads naturally to the next rule of the investor's shield. Rule 13. Study history. After learning to focus on long-term growth, the next rule of the investor's shield reminds investors of a powerful source of wisdom. That source is history. Financial markets may appear modern and complex, but human behavior within markets has remained remarkably consistent for centuries. Fear, greed, optimism, and panic have influenced investors in every generation. Because human nature does not change easily, many patterns in the stock market repeat themselves over time. Investors who study history gain the ability to recognize these patterns. They develop perspective and avoid many of the mistakes that repeatedly harm new investors. Markets have experienced many dramatic events. There have been powerful booms where excitement drove prices to extreme heights. There have also been painful crashes where fear pushed prices far below their true value. Each of these events contains valuable lessons about investor behavior. For example, periods of rapid market growth often create widespread optimism. Investors begin to believe that prices will continue rising indefinitely. New participants enter the market hoping to benefit from easy profits. During such times, caution often disappears. Then eventually, reality returns. Prices correct and excessive optimism fades. The same pattern has appeared many times in financial history. Investors who understand these cycles become less vulnerable to emotional extremes. They recognize that periods of great excitement are often followed by periods of correction. They also recognize that deep pessimism sometimes creates valuable buying opportunities. One of the most respected voices in long-term investing, Benjamin Graham, emphasized the importance of understanding market behavior. Graham observed that markets can become irrational in the short term because of emotional reactions from investors. By studying past market cycles, investors learn to recognize these emotional patterns and respond with greater discipline. History also teaches investors about resilience. Many beginners believe that a major market decline signals the end of investing opportunities. When prices fall sharply, fear spreads quickly and pessimistic predictions dominate the news. But history tells a different story. Despite numerous crises, wars, recessions, and technological changes, markets have repeatedly recovered and continued growing over the long term. This resilience reflects the strength of businesses and human innovation. Companies adapt, economies evolve, and new industries emerge over time. Investors who understand this long-term pattern develop greater confidence during difficult periods. Instead of reacting with panic, they remember that previous generations of investors faced similar challenges and eventually witnessed recovery. The legendary investor Warren Buffett often reminds investors that the world continues to progress despite temporary setbacks. Throughout history, humanity has overcome countless difficulties while continuing to innovate and create value. This long-term progress has supported the growth of businesses and markets. Another important lesson from history involves valuation. Certain periods in market history show how excessive enthusiasm can push prices far above the true value of companies. When investors ignore fundamentals and chase excitement, bubbles may form. Eventually, these bubbles burst, often causing significant losses for those who entered too late. Studying such events helps investors recognize warning signs and remain cautious during periods of extreme optimism. History also highlights the importance of patience. Many successful investors built their wealth not through rapid speculation, but through decades of disciplined investing. Their stories demonstrate how consistent decision-making and long-term thinking can create extraordinary outcomes. By studying these examples, investors gain inspiration and practical guidance. They learn that successful investing is less about predicting the future and more about applying timeless principles consistently. Another advantage of studying history is perspective. When investors understand the long journey of markets, short-term volatility becomes less alarming. Temporary declines appear as part of a much larger story rather than as isolated disasters. This perspective helps investors remain calm when markets become turbulent. It strengthens discipline and reinforces long-term strategy. However, while studying history provides valuable insights, investors must also remember another important challenge. Markets are influenced by millions of participants making decisions at the same time. Crowds often behave emotionally, especially during moments of excitement or fear. Following the crowd without independent thinking can lead investors into dangerous situations. Understanding this tendency introduces the next rule of the investor's shield. Rule 14. Avoid following the crowd. After learning the lessons of history, the next rule of the investor's shield focuses on another powerful influence in financial markets. That influence is the crowd. The stock market is not controlled by a single person or a small group of people. It is shaped by the actions of millions of investors around the world. Each of these investors brings their own emotions, expectations, and opinions into the market. When large numbers of people begin thinking in the same way, powerful trends can appear. These trends can push prices far above or far below the true value of businesses. The natural instinct of human beings is to follow the crowd. When many people are doing something, it feels safe to do the same. This instinct may be helpful in some situations in life, but in the world of investing, blindly following the crowd can be dangerous. Crowds often become most enthusiastic near market peaks. During these times, excitement spreads quickly. Investors hear stories of easy profits and rapid success. News headlines celebrate the strength of the market. Many people begin investing not because they understand businesses, but because they fear missing out on profits. This emotional pressure encourages investors to join the crowd without careful thinking. Unfortunately, this behavior often leads to buying when prices are already very high. Then the cycle changes. When markets decline, the crowd reacts in the opposite direction. Fear spreads rapidly. Negative predictions dominate financial news. Investors who previously felt confident now begin selling their investments to escape uncertainty. The crowd that once rushed to buy now rushes to sell. History has shown this pattern many times. The legendary investor Sir John Templeton observed this behavior clearly. He explained that the time of maximum pessimism often creates the best buying opportunities, while the time of maximum optimism often signals danger. This observation reveals an important truth. Crowd emotions frequently push prices away from their true value. Wise investors learn to observe the crowd without blindly following it. They remain calm when others become emotional. This independence requires confidence and discipline. It is not always comfortable to act differently from the majority. When everyone around you appears confident about a particular investment, it can feel difficult to remain cautious. But thoughtful investors understand that popularity does not guarantee quality. They rely on careful analysis rather than social pressure. The philosophy of independent thinking was strongly supported by Warren Buffett. Buffett often encourages investors to make decisions based on business fundamentals rather than crowd behavior. He reminds investors that the market offers opportunities precisely because others sometimes behave irrationally. When investors allow emotions to dominate their decisions, prices can move far away from the underlying value of businesses. Independent investors can benefit from these situations by remaining patient and disciplined. Avoiding the crowd does not mean automatically doing the opposite of what everyone else is doing. Sometimes the crowd may be correct. The important point is to make decisions based on thoughtful analysis rather than social pressure. Investors should examine the strength of the business, the fairness of the price, and the long-term prospects of the company. If these factors are strong, the investment may be worthwhile regardless of whether the crowd currently agrees. Independent thinking also protects investors from popular market trends that lack strong foundations. Every generation experiences new investment fads. Certain sectors or technologies suddenly become extremely popular. While some of these innovations eventually succeed, others fail once excitement fades. Investors who simply follow trends without understanding the underlying businesses risk significant losses. Disciplined investors remain curious but cautious. They study new opportunities carefully rather than rushing into them. This balanced approach allows them to participate in genuine innovation while avoiding speculative bubbles. Another benefit of independent thinking is emotional stability. When investors rely on their own research and reasoning, they feel less pressure to react to the changing opinions of others. Their decisions become more consistent and thoughtful. Over time, this independence becomes one of the greatest strengths an investor can develop. However, even independent investors need a clear and practical framework for making decisions. Without a structured approach, investing can still become confusing and inconsistent. This leads to the next rule of the investor's shield. Rule 15. Build a simple strategy. After learning the importance of independent thinking, the next rule of the investor's shield introduces a powerful principle that protects investors from confusion and inconsistency. That principle is simplicity. The world of finance often appears complex. There are countless strategies, indicators, predictions, and theories about how to succeed in the stock market. New systems are constantly introduced, each claiming to offer superior results. For many investors, this complexity creates uncertainty. They feel that successful investing must require complicated methods or advanced calculations. But history shows that many of the most successful investors follow surprisingly simple principles. Simplicity brings clarity. Clarity brings discipline. And discipline leads to consistency. When investors rely on complicated systems, they often struggle to follow them during periods of market stress. Too many rules can create confusion and hesitation, but a simple strategy is easier to understand and easier to follow even when markets become volatile. A good investment strategy should answer a few essential questions. What types of businesses should be purchased? How much capital should be invested in each opportunity? How long should investments be held? Under what conditions should an investment be sold? When these questions are answered clearly, investors gain a reliable framework for decision-making. One of the most respected investors in history, Warren Buffett, has often emphasized the value of simple investment principles. Buffett focuses on understandable businesses, reasonable prices, and long-term ownership. This approach may appear straightforward, but its effectiveness has been demonstrated over decades of disciplined application. Another reason simplicity is powerful is that it reduces emotional pressure. When investors rely on complicated signals and predictions, they may feel uncertain about every decision. Conflicting information can create anxiety and hesitation. But a clear and simple strategy provides confidence. Investors know the principles guiding their actions. They understand why they are making each decision. This confidence becomes extremely valuable during periods of market volatility. When markets decline sharply, many investors abandon their plans because fear becomes overwhelming. But those with simple and well-understood strategies are more likely to remain disciplined. Simplicity also improves learning. When a strategy is clear, investors can evaluate their decisions more effectively. They can identify what worked well and what needs improvement. Complex strategies often hide mistakes behind layers of complicated reasoning. Simple strategies reveal both strengths and weaknesses more clearly. Another advantage of simplicity is flexibility. Markets evolve over time as technology changes, new industries emerge, and economic conditions shift. A simple strategy based on timeless principles can adapt more easily to these changes. For example, principles such as buying quality businesses, maintaining patience, controlling costs, and focusing on long-term growth remain valuable in almost every market environment. Complex strategies based on narrow predictions often fail when conditions change unexpectedly. Simplicity also encourages focus. Instead of constantly searching for new techniques, investors concentrate on understanding businesses and improving their judgment. This focus leads to deeper knowledge and stronger decision-making over time. The legendary investor Charlie Munger often reminded investors that complicated solutions are rarely necessary for successful investing. He believed that clear thinking and simple principles are usually more powerful than complex financial models. Another important benefit of a simple strategy is consistency. Investing success rarely comes from a single brilliant decision. It comes from many thoughtful decisions made consistently over many years. A clear strategy acts like a compass that keeps investors moving in the right direction. Even when markets become unpredictable, the strategy provides guidance and stability. Over time, this disciplined consistency allows compounding to work effectively. However, even the best strategy cannot eliminate uncertainty completely. Markets remain unpredictable, and unexpected events can influence even the strongest businesses. Because of this uncertainty, investors must approach the market with humility rather than arrogance. Recognizing the limits of knowledge and prediction becomes an important part of long-term investing success. This understanding leads to the next rule of the investor's shield. Rule 16. Stay humble before the market. After building a simple and disciplined strategy, the next rule of the investor's shield teaches a quality that protects investors from dangerous overconfidence. That quality is humility. The stock market is one of the most complex systems in the world. Millions of investors participate in it every day. Each participant brings different information, expectations, and emotions. Because of this complexity, the future of the market can never be predicted with complete certainty. Even the most experienced investors occasionally make mistakes. Unexpected events can influence businesses, industries, and entire economies. When investors forget this reality, overconfidence can appear. Overconfidence is a dangerous mindset. It creates the belief that one can predict market movements with certainty or avoid mistakes completely. This belief often leads investors to take excessive risks. They may concentrate too much capital in a single investment. They may ignore warning signs or dismiss opinions that challenge their assumptions. Overconfidence can transform a thoughtful investor into a reckless one. Humility acts as protection against this danger. A humble investor understands that knowledge has limits. They recognize that the market can surprise even the most intelligent participants. This awareness encourages caution and careful decision-making. One of the greatest investors in history, Warren Buffett, has often demonstrated humility in his approach to investing. Buffett frequently explains that he focuses only on businesses he understands well. He avoids industries that fall outside his circle of competence. This disciplined restraint reflects humility. Instead of attempting to understand everything, he concentrates on areas where his knowledge is strongest. Another important voice in the investing world, Charlie Munger, also emphasizes the importance of intellectual humility. Munger often reminds investors that the world is too complex for anyone to know everything. Recognizing this limitation encourages continuous learning and careful thinking. Humility also improves risk management. When investors acknowledge uncertainty, they naturally become more cautious about how they allocate capital. They diversify their investments. They avoid excessive speculation. They maintain a margin of safety in their decisions. These protective actions reduce the impact of unexpected events. Another benefit of humility is openness to learning. Markets evolve constantly as new technologies, industries, and economic conditions emerge. Investors who believe they already know everything often stop learning. Their thinking becomes rigid and outdated. Humble investors behave differently. They remain curious. They continue studying businesses, economic trends, and market history. This curiosity allows them to adapt as the world changes. Humility also improves emotional discipline. When investors become overly confident, they may interpret short-term success as proof of superior ability. A few profitable trades can create the illusion that future success is guaranteed, but markets often change quickly. Strategies that work in one environment may fail in another. Humble investors remain cautious even after success. They recognize that favorable results may sometimes involve luck as well as skill. This balanced perspective protects them from becoming careless. Another important aspect of humility is patience. Investors who believe they must always prove their intelligence may feel pressure to act constantly. They trade frequently to demonstrate confidence in their predictions, but humble investors are comfortable waiting. They understand that the market will always provide new opportunities. There is no need to rush into uncertain situations. This patience supports the long-term principles discussed earlier in the investor's shield. Over time, humility becomes a powerful strength. It encourages careful thinking, continuous learning, and disciplined risk management. Instead of trying to dominate the market, the humble investor learns to work with it. They accept uncertainty while applying thoughtful judgment. However, humility alone does not create wealth. For wealth to grow meaningfully, investors must allow another powerful force to operate over long periods of time. That force is compounding. Understanding how consistent returns accumulate over time reveals one of the greatest secrets of long-term investing. This insight introduces the next rule of the investor's shield. Rule 17. Let compounding do the work. After learning the importance of humility, the next rule of the investor's shield introduces one of the most powerful forces in investing. That force is compounding. Compounding is simple to understand, but extraordinary in its impact. It occurs when investment returns begin generating their own returns over time. Instead of earning profits only on the original capital, investors begin earning returns on both their capital and the profits that have already accumulated. This process may appear slow at first. In the early years, growth may seem modest, but as time passes, the effect becomes stronger and stronger. Small gains begin to build upon each other. Each year adds another layer of growth. Over long periods, this steady accumulation can transform modest investments into substantial wealth. The idea of compounding has fascinated thinkers for generations. The renowned scientist Albert Einstein is often associated with describing compound growth as one of the most powerful forces in nature. Whether applied to finance or science, the principle remains the same. Growth that builds upon itself becomes increasingly powerful over time. Successful investors understand that compounding requires two essential ingredients. The first ingredient is time. The second ingredient is consistency. Time allows the compounding process to continue year after year. Consistency ensures that the investment continues generating returns that can be reinvested. Without time, compounding cannot reach its full potential. Without consistency, the process becomes interrupted. Many investors unintentionally interrupt compounding. They move their money frequently from one investment to another. They chase short-term opportunities that promise rapid gains. They sell strong investments too early because they become impatient. Each of these actions restarts the compounding process. Instead of allowing wealth to grow steadily, the investor begins again from the beginning. Patient investors behave differently. They search for strong businesses capable of growing over many years. Once they find such companies, they allow time and business growth to work together. This patience allows compounding to operate with increasing strength. One of the most famous examples of long-term compounding is the investment career of Warren Buffett. Buffett began investing at a young age and continued applying disciplined principles over many decades. The remarkable growth of his wealth illustrates how powerful compounding can become when given enough time. Another lesson from compounding is that consistency often matters more than dramatic short-term success. Some investors attempt to achieve extremely high returns quickly. They take large risks, hoping for extraordinary gains. While this approach may occasionally produce impressive results, it also increases the possibility of large losses. Compounding works best when returns are steady and sustainable over long periods. Even moderate annual growth can produce extraordinary results when allowed to accumulate for many years. This understanding encourages investors to focus on stability rather than speculation. Instead of chasing the highest possible return, they aim for reliable growth supported by strong businesses. Compounding also rewards discipline. Investors who remain committed to their long-term strategy allow their investments to grow naturally. They resist the temptation to react emotionally to every market movement. This discipline keeps the compounding process intact. Another important aspect of compounding is reinvestment. When companies generate profits, they may reinvest those profits to expand operations, develop new products, or enter new markets. These reinvestments create additional growth opportunities. Investors benefit when businesses successfully reinvest their earnings into future expansion. Over time, this cycle strengthens the value of the company and the investment itself. Compounding also teaches an important lesson about patience and perspective. Early stages of compounding may appear slow and unremarkable. Some investors become discouraged because they expect faster progress. But those who understand compounding remain patient. They know that the most dramatic growth often occurs after many years of steady accumulation. The later stages of compounding can produce results that seem almost surprising compared to the early years. This transformation is possible only when investors allow the process to continue without interruption. The investor who respects the power of compounding begins to think differently about time. Instead of seeking immediate rewards, they focus on building a foundation for future growth. They recognize that every year of disciplined investing strengthens the compounding process. Over decades, this quiet and steady force can become the foundation of lasting wealth. However, even with patience, discipline, and compounding, investors must remember one final principle. Markets will always experience uncertainty, volatility, and unexpected challenges. The ability to remain committed to sound principles during difficult times becomes the ultimate test of an investor's character. This final idea leads to the last rule of the investor's shield. Rule 18. Stay the course. After understanding the power of compounding, the final rule of the investor's shield brings together all the principles that came before it. That rule is simple but extremely powerful. Stay the course. Investing is not a straight road. It is a long journey filled with changing conditions. There will be periods of strong growth when optimism fills the market. There will also be periods of uncertainty when prices fall and fear spreads among investors. These fluctuations are natural. They have appeared in every generation of financial markets. Yet many investors struggle during these moments. When markets decline sharply, confidence disappears quickly. Investors begin to question their decisions and their strategies. They wonder whether they should abandon their investments to avoid further losses. At the same time, dramatic predictions often appear in the news. Experts discuss possible economic disasters and long periods of decline. This atmosphere of fear makes it extremely difficult for investors to remain calm. But history teaches a powerful lesson. Markets have experienced countless crises, recessions, and global events. Despite these challenges, businesses have continued to grow, innovate, and create value over time. The global economy has adapted again and again. Investors who remained disciplined during difficult periods often benefited when recovery arrived. One of the most important qualities of successful investors is persistence. They do not abandon their strategy simply because markets become volatile. They continue applying the same thoughtful principles that guided them during calmer times. This consistency allows long-term investing strategies to work as intended. The legendary investor Warren Buffett has often demonstrated this philosophy. Throughout many decades, he remained committed to patient, disciplined investing even during periods of economic uncertainty. His approach shows that staying the course does not mean ignoring risks or refusing to learn. Instead, it means maintaining confidence in sound principles while adapting thoughtfully when necessary. Staying the course also requires emotional strength. During strong bull markets, investors may feel pressure to chase fashionable investments that promise quick gains. But disciplined investors remember the earlier rules of the investor's shield. They avoid hype, focus on quality businesses, and remain patient. During market downturns, the opposite pressure appears. Investors may feel tempted to sell everything in order to escape uncertainty. But those who understand the long-term nature of investing remain steady. They remember that temporary declines are part of the market cycle. As long as the underlying businesses remain strong, time often restores value. Another reason staying the course is so important involves compounding. Compounding works best when investments remain in place for long periods. Frequent changes in strategy interrupt this process. Each time investors abandon their plan, they reset the compounding journey. Consistency allows compounding to operate with increasing power over the years. Staying the course also strengthens personal discipline. Each time investors remain calm during a difficult market period, their confidence grows. They develop greater trust in their strategy and their ability to think independently. This confidence becomes a valuable asset during future market cycles. Another important aspect of staying the course is maintaining perspective. Short-term market events can appear dramatic when viewed closely. But when investors step back and observe the long history of markets, they see a broader pattern of growth and innovation. New industries emerge, technologies evolve, businesses adapt to changing conditions. This ongoing progress supports the long-term growth of the global economy. Investors who remain patient participate in this progress. The respected investor Sir John Templeton once reminded investors that bull markets are born in pessimism, grow in skepticism, mature in optimism, and die in euphoria. Understanding this cycle helps investors remain calm when emotions dominate the market. The disciplined investor does not attempt to predict every movement. Instead, they focus on following sound principles over time. In the end, investing success rarely comes from extraordinary predictions or sudden opportunities. It comes from applying simple principles consistently over many years. Protect capital. Understand businesses. Think like an owner. Be patient. Control emotions. Diversify wisely. Respect the power of time and compounding. These principles form the shield that protects investors from common mistakes. The market will continue changing. New challenges will appear and new opportunities will emerge. But the investor who follows these timeless rules and remains committed to the journey will always have an advantage. Because in the world of investing, those who stay the course are often the ones who reach their destination.